Welcome to this week's live ASX strategy session. Thanks for joining me. Great having you with me for another show. Plenty of interesting things going on this week with the rebound in the stock markets. Got some movement in the commodities, which is also interesting to consider. And I want to go through any stock codes that you want me to have a look at. Look at the technical structure of those, see what's happening in those stocks. We'll go through that at the towards the end of the segment. Now, as always, everything today is general commentary only, doesn't take your personal situation into account. Now, with all that said, let's get into this week's first chart. So I've got the ASX 200 up here on the screen, and the ASX 200 is now less than 1% above where it was last week. So you look where the market was last Friday, where it is now. Hasn't been a whole lot of movement. But that said, there have been some really important developments. And this is also the case in the US markets. I'll go through that in a moment. But let's just start with this chart here, the ASX 200. Now, the big hope for those who are bearish on stocks, those who are looking for the markets to fall, I think the big hope for them was this potential development of a head and shoulders pattern. Now, a head and shoulders pattern, this is a pattern that sometimes appears at market tops, and it can be warning of an approaching turning point. So if you don't know, this is the left shoulder over here. Then we have the head of the pattern, and then we have the potential right shoulder developing. It's one of those classic technical analysis patterns. But I think the price action that we've had last week, it really does start closing the window on the possibility that this turns into a bearish pattern. What we have here is the ASX 200 is now nearing its December high. If the head and shoulders structure was going to work, what should really happen with these structures is the buying interest within the so-called right shoulder, which is over here, the most recent period, the buying interest within that shoulder would start to weaken, and the rally would start being met with some enthusiastic selling. Now, that's not what we've seen. And when we see this pattern unfold, and you see that sort of price action that I just outlined, it helps identify changing price structure. But that's not happening here. Just look at the strength we have off the recent low, the low from the 13th of January. I think what the strength of that rally off the low tells us is that it shows us that there's plenty of interest in buying the dip. So buying interest remains strong on dips. I think if a bearish scenario was gaining, if a bearish scenario was gaining traction, then prices probably should have stalled around the January high, and it now would be focusing on prices coming back towards the January and the December lows. But as I say, that's not what we're currently seeing. As we discussed last week, my bias in these situations is to default back to the incumbent trend. And the incumbent trend in this case, for the last 12 months, it's been very much to the upside. Now, what we have when we look at this chart, look at the moving averages. We've got the 50-day and the 100-day moving averages. So they still remain positive. They're still rising. And price is the ASX 200's price. It's generally holding above those moving averages. Until we get a clear breakdown, and we have not had a clear breakdown over the course of this last 12 to 13 months, until we get a clear breakdown, I think it remains a case of staying long stocks. Now, one thing which is really important to remember is that every bullish phase is going to come into question at some point. In fact, they come into question quite often. Like, you just think of all the dips and consolidations and pullbacks we've had throughout the last year. The upward trend comes into question quite a lot. This is typically when momentum stalls and prices start to consolidate, much like we've been seeing over the last 6 or so weeks. And that's what we've been experiencing just recently. I think some extra caution has been warranted during this pullback as prices have come below the moving averages, because this is when trend reversals can happen, and this is how a reversal can start. but I don't want to sell. I don't want to sell out my portfolio and move to cash at every hint of trouble, because there's always hints of trouble, but hints that don't turn into anything of substance. And if I was selling every time there was a hint of trouble, well, I'd never be able to stay on big trends. And it's the big trends where I make most of my money. Now, one other index I want to have a look at locally is the equal weight. Coming across just quickly, looking at the ASX 200 on an equal weight basis. What we have here, it's moved from a vulnerable position, trading below moving averages, to now being back above the moving averages. And it's now within sight of its all-time high. It's not too far beneath there just now. So the strong rally we've had off the lows from a couple of weeks ago, what that does, I think it really does disengage the potential bearish setup that was developing when prices were consolidating below the moving averages. And this is when I think the market really was at most risk. As I often say, most of the bad stuff happens when price is below declining moving averages. I think looking at this now, price may not immediately move higher. It's entirely possible we see more backing and filling and consolidation above the moving averages. But I think the window of vulnerability that was in place just a couple of weeks ago, I think that is now passed. As I told you last week, I'm happy to keep holding stocks that remain in uptrends. I'm also managing those positions with wide trailing stops. And the aim of the wide trailing stop is to see off these consolidations that we periodically get within rising trends. And I'm also moving some of the cash I put on the sidelines when prices looked like they were vulnerable. I'm moving some of that cash back into the market. I think the path of least resistance, when we look at this underlying trend, it remains upwards and the odds favour higher levels, maybe in the weeks ahead. Now, if you're getting some value from this, please hit that like button. Please leave a short comment. Just, hey, thanks for the video. YouTube sees that and shows other people, and that helps me heaps. So please do those things. Like and short comment. Just click that like button now while you're thinking about it. Now, S&P 500. Let's move over to the US markets. And hasn't this been full of surprises? So 2 weeks ago, I was telling you about this coiling pattern into the moving averages. So we had the price high in December, price came back, consolidating sideways along the moving averages. And I was telling you about how this was one of my favorite bullish setups when price does that, when it coils along the moving averages. No sooner had I said that than prices broke to the bottom side of this of the coiling pattern. And then not long after that, though, we had the rebound back into the range. So that left us with a false break, and now we had the rally to new all-time highs. I'll come back to the S&P 500 specifically in a moment, but I just want to quickly talk about false breaks and what you can learn from them. And I think this is a really good example. I think it's a great example of how false breaks can be an excellent indicator to the market's next move. So what we have here, so when you get a market that's trading sideways, it breaks down, and then that breakdown is quickly rejected, prices move back into the range. It's telling us two things. It's giving us two indications. It's suggesting, firstly, that selling pressure is not as strong as may have been feared. Prices haven't attracted that follow-through selling, haven't continued lower. That's telling us that first. The second thing it's telling us is that there's interest in buying the dip, potentially strong interest in buying the dip as pushing prices back higher. When a market breaks to the downside and it can't sell off, then that's a sign that the path of least resistance remains to the upside. The opposite applies when you get a failed breakout to the upside. So when a pattern breaks to the upside, then quickly pulls back in, it's telling the opposite. So keep an eye out for false breaks, and importantly, just know what they're potentially telling you, because they can really help you. They really give you a look at the market's hand. You see, get a good idea of what might be coming up next. Now, just coming back to this structure, looking at this chart, prices are again rallying off the moving averages. We saw similar price action April, back in April, August, and also in September, and we're seeing it again now. So back to the moving averages and rallying off. Same type of price action is playing out in the Nasdaq. So from a technical perspective, this remains what I describe as a textbook uptrend, with the dips being bought along the way. And at some point, of course, the market will peak and there'll be a final high, and the market will then enter a larger correction. But the thing is, nobody knows when that's going to be. Rather than trying to predict it, I think the correct play is to simply go with the trend. Go with an established trend, stay in the trend for as long as possible, and use a trailing stop to manage risk. And the thing to always keep in mind is nobody knows how far a trend will run. There'll always be plenty of predictions about the market's going to top, the market's going to crash, it's expensive, it's overvalued. It goes on and on and on. But nobody actually knows when a market is going to peak. So staying with the trend is how a lot of the money is made. The big money is often made by maximizing time on big trends, not by trying to pick tops, which often turn out to be temporary pauses before we see higher levels. Now, just coming back to one of my concerns over the last few weeks, and that's been a thinning of the participation in this rally. Now, we can see that if we go over to an equal weight. So S&P 500 on an equal weight basis. Now, this looks a bit like the ASX 200 in that it had been consolidating below moving averages, which had started to roll over. It'd been doing that for nearly a month. That opened a window of vulnerability. Now, as I always say, vulnerability doesn't mean a market will fall. It simply points out to the potential that there's a structural shift maybe underway in the market, and that there's an elevation of risk. And with the equal weight coming back and having that elevated risk, it also showed that an increasing number of stocks weren't participating in the rally that we're seeing in the S&P 500. Now, the good news here is that I think that window of vulnerability is closed. We talked about this last week. We talked about this rally off the low last week, and that's been reinforced just over the last few days with prices again moving higher. We can also see the participation increasing when we look at the number of stocks above their 100-day moving average. So have a look at this indicator here. It's showing us a percentage of S&P 500 stocks above their 100-day moving average. A couple of weeks ago, that got down to 29%, so only 29% of stocks was above their 100-day moving average. Now that's moved up to 52%. There's been a significant swing back in the number of stocks above their 100-day moving average. So that's telling us a lot more stocks are now participating in this rally, which I think is positive, and it's another sign that I think we want to give this trend to continue to stay with this trend we're seeing in stocks. Now, coming back to the equal weight, now it could be said that we do have bearish divergence at the moment. Bearish divergence is when the current price doesn't get back to the previous peak when another index does. So the S&P 500 is at a new all-time high, but we go to the equal weight version, it's not at an all-time high. You can still see there's a considerable gap. So that in itself is divergence, which can be negative. I think the point to remember is, though, if the market continues to rally in the next few weeks, that divergence could well and truly disappear. And this is the thing with divergence. You need to be careful how you use it. And my overall view on this, it hasn't changed. I think the play here is to stay long and side with the rising trend. And where we get this divergence coming in, I think it's a case of overlooking the divergence and instead focusing on what is the broader upward trend. And what I've done over the last week or two, where I've scaled back some of my risks during this window of vulnerability, I've now started to increase that exposure again. as I said last week, I think it's a case of staying flexible, being prepared to adjust your portfolio to suit the conditions. And as it stands, I think the signs are that we're re-entering a risk-on phase with prices getting back above these averages and momentum returning. So now I'm going to go on to the US small caps, the local small caps. We've got them as well. Got the commodities to go through, which are really interesting this week with some opportunities opening up. And I've got a couple of stocks I want to show you, which I also think are really interesting to look at, which are currently breaking out on the ASX. And any stocks you have, we're going to go through them, so have those tickers ready. But of course, that wraps up the free section. So if you're not a Strategy Session member, there's a link below. Click that. Come on board. It doesn't cost you very much for the small contribution it takes to basically to pay for all this and make this happen and pay for the time and production and cost to put it all together for you. And you won't get today's free section. You won't get today's live session, of course, but you'll get the full replay. And next week you'll be here for the whole thing. So think about doing that. Now, okay, so coming over to the small caps.